Welcome to The Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is Friday, March 31st, 2023. S&P 500 currently sitting at, wouldn't you believe it, 4082. I'm David Zarling. I'm here with Ian Trampoline Park aficionado McMillan. Back into the 4080 level. Plenty to talk about. Where would you like to start?
Yeah, 4080. Wouldn't you believe it? I would believe it.
An important area that goes back all the way to last year. As we've mentioned on here, it feels like 100 times.
I was going to say, I'm sure everyone's rolling their eyes.
And that's okay.
All of our listeners.
That's okay.
Hey,
because
it's a big level.
It's a huge level. It's a breakdown level back in the early part of 2022. Early May, we consolidated there in late May and broke down. We did the same thing in February of this year, and we're back to the area. And some would call that potentially chewing through supply. Right, where sellers have shown up in the past. And I know maybe it was 2 podcasts ago, Ian, maybe 3, we highlighted this 4080 level and how we had 90% down days to the downside. So breadth to the downside that took place in February and in March. And we're back here again. And now we could call it the scene of the crime, back to the scene of the crime and see what takes place here from a selling perspective.
Back to the scene of the crime. So, a big move, a rough month overall, right? So we're coming into the month end, quarter end, Q1 2023. Wow. We
get weekly candles, monthly candles, and quarterly candles after today. That's a good thing.
So lots of information. Obviously, the month got off to a pretty wild start with small caps and the whole banking fiasco, right? So pretty sure that was the first week of March, maybe second week.
Yeah, spilled over into the second week.
I guess closer to the second week, that Thursday, Friday, the 9th and the 10th.
I do believe it was the 11th and 12th that Signature Bank and Silicon Valley were put into receivership.
Yeah. And so Russell, which most exposure regional banks, it's the one that got hit the most. Back to kind of some of that behavior that Friday, the second day of it. We're kind of back there if we look at IWM 176. The Qs, Nasdaq basically bottomed, as a short term. Didn't really even flinch that much. It's already out to year-to-date highs to end the quarter, most likely, barring some type of major collapse here in the next 2 hours. S&P, the an average of those well above its price from. In fact, S&P will go out at the highs of the month after all that.
Pratty took a sneak peek at monthly candles last week. And they were sitting at dojis, and here we're at a level where you're going to be potentially closing at the highs of the month, which is typically indicative of strength of demand, whether you're looking at a daily candle of information, a weekly candle information, and a monthly. And you go back to the close at the end of May of 2022 was 4130-ish. You look at July of 2022 was 4130. The close in November of 2022 was 4080. The close in January of 2023 this year was 4076. And here we are currently sitting at 4083. And
so using your numbers, highest close would be the highest monthly close, again, if we were to close right now, since that's last summer then.
Right. Since last summer. With a lot of volatility in between.
So much volatility, more than I personally needed.
And from a technician standpoint, talking a little bit of shop, if you were to compare February of last month to this month, you have a dueling tails scenario where, in essence, a 2-month price development or study would show you kind of, if you were just taking 2 months of information, that would be more of a doji. But it is important and notable, and we're several hours yet away from close. If we were to, close above some of those levels I just mentioned, that would be pretty huge information from a monthly standpoint using something like the S&P 500.
And yet, all of this volatility, and I gotta be honest, it's done nothing to tell me what type of trend we're in.
Yeah, still developing.
Huge moves, right? Big week. It's going to be a big week. It seems, or a nice week. It's going to be a solid week. It's not like we were up 7% for the major indices. But outside of the Nasdaq, I mean, you got a lot of price history to the left.
You do. And I would say it's a tale of two different things going on. S&P, if we closed here, would be flat since a monthly close of May 2022. Small caps would be about 4% lower from May of 2022, while the Nasdaq, to your point, would actually be higher. And that's an interesting dynamic because that's not really what unfolded in the third and fourth quarter of last year, was where we were seeing strength out of small and value and weakness out of growth and tech. That has quickly flipped.
Oh,
and
this was supposed to be a big value year based on Q4.
Right. And there's two ways to take that. Rotation is the lifeblood of markets.
True.
We know that these large cap, or I should say capitalized based indexes or indices, the large cap names tend to get larger. That's the concept of momentum.
Momentum and market caps, man.
And that's one of the most prevailing factors in markets is momentum.
I would say it's the only prevailing factor.
And I think this would be a good segue to our sponsor of this podcast, the Adaptive Select ETF, listed on NYSE under ticker ADPV, helps investors access two of the most prevalent factors in markets, momentum and relative strength. Through proprietary identification methods, the Adaptive Select ETF attempts to own the strongest 25 large cap stocks when the market is in an uptrend. And since not all market environments are the same, Adaptive Select seeks to prevent extended declines by moving to short-term T-bills and cash during long-term market downtrends. Investors can find out more, including how to invest in ADPV, by visiting adpvetf.com or calling 1-833-753-3825. And an important disclosure, investing involves risk, including possible loss of principal. This ETF is distributed by Quasar Distributors, LLC. And there you have a product that uses momentum in its process and indices, right? Some would argue that S&P 500 is one of the best momentum products,
indices, yeah,
right? Because it's the large cap names that keep getting larger in uptrends.
I mean, it's an actively managed momentum product,
basically.
But no, a lot of people, none of your bogleheads want to hear that, but I could make a pretty strong case for that.
You have underneath the surface of, and there's two different ways to define the stock market, right? It's, yes, some people would say, oh, the stock market is the Dow Jones, or the stock market is the Nasdaq, or the stock market is the S&P 500, or the stock market is the NYSE, or it's the market of stocks. What's happening with all stocks?
All stocks. We're active managers. Nothing about what we do. I mean, contrary to 95% of wealth management firms out there, nothing about what we do is buy and holding or trying to hug up against some type of index and just ride it out. And I think where you're going with this is kind of the dispersion we've seen with the index and, stock market versus a market of stocks. I think Willie Dewish had a good tweet on that too, but it's certainly, there's some splitting there.
For sure.
Year to date.
Yeah, year to date. There's been a little bit of a flippening. That might not be a word, but a flippening of your small value in 2022 was a place to be. In 2023, that has quickly changed back to your large cap, back to your growth names. Now, when you look at those relationships using something like the Nasdaq 100 versus the S&P 500, you're right up against important levels that go back in time. And is there an advantage at this point? There's been a lot of energy used to get to this point in that relationship where now you could see a rotation back into some other these small cap names. Now that's TBD. We talked, I believe it was last week, about financials and XLF needing to hold $30. And
Did it?
yeah, it did. It's still there. It's around 32. It held. And does that continue? That's to be determined. But the fact that it's above, it's got work to do. It's one of those things, and you've said it in the past, Ian, it doesn't have to be outperforming as long as it's not falling.
Mm-hmm.
And if we're above $30 on XLF, you have a potential for a market to be okay. 2 podcasts ago, I highlighted how many bottoms take place in March. That thesis is still alive, especially considering where maybe you did have capitulation underneath the surface during this rotation. So what do I mean by that? Since the end of January, you had pretty good deterioration in breadth. Meanwhile, rotation into large caps. But the deterioration in breadth in some ways looks like capitulation. And what I mean by that is you have bullish percents across the NYSE, all world, Nasdaq, optionable, that are all below 30 or 20, which is washout levels that if we now see a resurgence out of small, and resurgence doesn't have to be outperformance, it just has to be stop going down and start moving up, that now you're going to see this broadening out of breadth after 10 months of moving sideways.
I think you could see that.
It's possible. And there's a fair amount of money that's been, quote unquote, sitting on the sidelines. And I know there's 2 different ways to read that. You mentioned Willie Delwish. He highlighted some information about the amount of liquid assets that are actually invested in markets is at one of its highs that goes back to, in time, including like the 2000 high. Now, what I don't know is if that information reflects, are there retail investors out there of their liquid assets that are actually short? Because we've seen pretty high inflows to inverse products that are bearish S&P that would then have to, if they sell that product, would actually become a buyer of the S&P along with high levels of cash that could push this market higher, even though the fundamental narrative hasn't changed.
True. Shorts, sellers become forced buyers at a certain point. So do you get another type of melt up? Very possible.
So the melt up thesis, right? That would be something where if we were looking at the VIX volatility index of the S&P 500.
Below 21.
Cannot
buy alcohol.
Unlike Pratty can now.
Unlike Pratty, happy birthday this week.
Yep, happy birthday to Pratty.
Can
buy alcohol.
Alcohol. I don't know if your mom listens to this, so I won't say anything other than that.
Would you have had it on your scorecard that Pratty would be 21 and the VIX would be less than 21 in the same week? I would not.
18 close, not even be able to buy cigarettes.
Right. I know there's a rule of thumb here, and really we've been above this, let's call it 17 to 18 level on the VIX. And there's 2 ways to view VIX. One would be it's a measurement of the anticipated volatility for the next 30 days for the S&P 500, the daily volatility. And there's a rule of dividing, what is that?
16.
Divide by 16. So right now we're about 18, divide by 16, we'll just call it just above 1. So you can expect 1% daily moves, up or down. The other way to understand VIX is what's called optionality premiums. How much does it cost to buy a call or a put? The higher that is, the higher the premium is on those products. And so here we're in an environment where if we break below this rate of trend that goes back to 2018, would you believe it, January of 2018, Ian, where we've seen
no way. What happened then?
Volmageddon.
That's when.
Yeah. So you had all these
went haywire.
Yeah, we have all these
still going on 5 years of that.
I do think
I know you and I share that thesis.
Yeah, it's ripples in the pond. And where I want to go with this actually is to paint the bigger picture. In January of 2018, a huge contingent of both institutional retail are short volatility using unique volatility products that carry massive risk. Sure enough, those trades explode. It impacts both retail and institutional in billions of dollars, with Credit Suisse being one of the bigger. They were the ones that issued XIV, which was a huge retail product at the time. And here we are, reverberations 5 years later.
Did someone say Credit Suisse?
Yeah, Credit Suisse. Lack of Credit Suisse. And they just got absorbed by UBS.
UBS. Imagine getting to buy your rival bank for $2 billion.
Yeah, Credit Suisse goes back ages, but here they were dealing in certain, and I would make the argument of, and you're going to have to help me pronounce the name of this, Ian, because I think I get this wrong every time. Archilagos. How do you say that? The name of that family office, Bill Huang. And I don't want to get into any. Yeah, I don't want to get into any libel or anything like that. You know, people take on risk, but here was a family office that was using swaps, with Credit Suisse being one of the most egregious.
Really?
Oh yeah, they went from a shop, you know, in the 2013, 2014 era of around 400 million. They had been in the $1 billion range more towards 2019, but then papered that up through these swaps up to 35 billion. And
that's what I'm doing this weekend. Papering up my swaps.
Yeah, right. Those indictments for Bill Huang and his associates took place in fall of last year. It happened to coincide with a bottom in the marketplace that had to do with Credit Suisse. And believe it or not, that was seed money for the ARC funds. So is a major story being missed here based on the counterparty risk that took place from Volmageddon, the family office that I can't pronounce. And even when you see what took place within, I'm not portraying that ARC funds did anything wrong. I'm just saying that were seed funds that helped drive up, that were part of the process. I think we could argue a bubbling process of some of the innovative tech names that were represented inside ARC that have since corrected, 70 to 80%. Are we at the final? Is that done? And the final piece of Volmageddon is done. That's the thesis. After 5 years, we finally unraveled all the consequences of Volmageddon and all the shorting that was going on with volatility, with UBS acquiring Credit Suisse and the reverberations of those products, along with.
We're done. We put the genie back in the bottle. Credit Suisse is done.
And wouldn't that be?
They're the ones that caused all this.
Well,
they had a product that went haywire.
When you observe market history and that we have 120% correction every 4.5 years, and observe that we had 3 of them in 5 ever since that market mile marker in January 2018, while everybody's focused on recession, inflation, M2, money supply, you name it, commercial real estate, all the negative narratives, that really it was about getting all this crap off the books that involved the volatility trade, that we now move higher in March, a familiar month.
What were those tickers?
XIV.
XIV, that's right.
TVIX, I believe, was another one, also product of Credit Suisse. Those are 2 of the major ones that I can think of at the time.
XIV, that's right.
Very clever, right? It's the inverse. It's the backwards of VIX.
That's wild to think that was over 5 years ago.
Right. But this goes back to, let's say we do move higher. Let's say we move up into this 4080 level. We reclaim 4180, a massive level where sellers have shown up before in the S&P 500. We sustain trade and we go on to move higher for the next 12 months. That doesn't mean that the narratives of today don't have some ramifications later, such as the banking things that we're seeing unravel now. And here's where I'm going with this. In 2008 and 2009, I would like to remind investors that in 2005 and 2006 is when we started to see defaults pick up in mortgages. It wasn't like at the peak that, now mortgages are defaulting. we went higher in the market for 2+ years while you had some things happening underneath the surface. You had Volmageddon happen 5 years ago, and we're finally wrapping that up with indictments last year and acquisitions this year. Do we get to be surprised that some of this banking quote unquote crisis that we're seeing now, that we still could see higher stock prices for another, 1 to 2 years? If we're above 4180, of course, you have to be above those prices for that thesis to be.
Got to be above 4180. And of course, we're talking about it, but you were going to have to get back to 4080 first.
Right.
To get back to 4080, which means you're going to have to hear Dave and Ian talk about it. And it just is what it is.
It's math, and
there's a lot of behavior at these areas in this range here, this 100-point range. It's not a massive range, but any technician that pulls up a long-term chart going back to, early 2021, there's a lot of investor reaction here on both sides of that range. I didn't draw the chart. It's just what's happened.
Oh, and we've got 3 pretty large cap names now: Apple, Microsoft, and Netflix. And not Netflix, NVIDIA, that are carrying and helping the market move higher. I believe you shared a tweet this morning with the team that highlighted that those 3 stocks were responsible for over 90% of the gain in the S&P this
91%
year.
of the gain has come from, in the S&P year to date, has come from 3 stocks. And outside that, John Roque also had a good graphic that he put on Twitter. So this is Q1, and he looks at the big 5 and the big 7 by market cap. The largest 7 stocks in the S&P up 44% this year.
Wow.
Largest 5 up 29. The S&P by itself, right? So 505 stocks, still market cap weighted, up 6. And if you take the S&P without those largest 7, you're actually -6 for the year. So again, we've talked about breadth thrusts on the podcast. Yeah, and we talked about January, right? Mid-January, and lots of things triggering. And I think a couple podcasts ago, we talked about all of these, it'd be the first time ever that this, XYZ signal didn't mark the beginning of a new bull market. And those things can still be true. We're not going to know till we look back in a few years from now. But from a year-to-date perspective, and January was strong. This is really I would say a February forward problem. Yeah, breadth it's just not a lot of things driving broad indices higher.
What's interesting, though, I'm going to repeat what you said just to make sure our listeners understand. If it weren't for the largest 7 stocks in the S&P,
out of 505,
the S&P would be down 6.
Yes.
And with it, it's +6 on the year. That's interesting. So you're sitting on a scenario where you rotated into these big 7 or the large cap names. In some ways, you have washout levels on breadth the last 2 months. So February and March, you really saw a washout in breadth, meaning really weak response to the January breadth thrusts upwards. But this scenario from a market moving higher thesis of rotating into big cap is probably better than the opposite, which is continued sell-off of big cap.
Yeah, probably don't want that, to be honest.
And so now it's like you got through some games in the season with your all-stars carrying the team, and now everybody just got healthy.
I would love that.
But that's only confirmed, right? Again, these are hypotheticals and they're called theses, right? That you don't get to express those theses until you've broken important levels. And again, 4080, 4180 on the S&P, that's important. The fact that we're now approaching levels we haven't seen since August of 2022 in the Nasdaq 100. If you use the Qs, QQQ, we're right up against the volume weighted average price from the all-time highs.
Yep.
We got to clear that. You look at small caps, the weakest of the group, heavily impacted by financials. As long as we're above 170, that's the thesis I just described has a strong potential. We'll see. But small caps have to hold that. We have to be able to sustain trade above 4080, 4180 on the S&P. What about internationally? What are we seeing? Because we kind of covered domestic.
We have, international is a theme for, I got to be honest, they've recovered pretty nicely. From a relative perspective, when I look at something like VGK.
VGK's Europe.
VGK's Europe. So on the back of all that U.S. regional bank stuff, we've talked about this, right? Most of these European country ETFs, they're heavily weighted towards financials. Their banks are kind of their apples. They just don't have a big weighting like we do to tech. So, what was the last big tech product to come out of Europe that was a world sensation? I don't know. Ericsson phones, Nokia. I have no idea. And I'm not trying to put down Europeans. I'm just saying our stock market is a little bit more heavily weighted towards tech. Europe a little bit towards financials. Had held up very well. Got hit a little bit on the back of the U.S. banking stuff. I got to be honest, it's recovered pretty nicely. And from a relative standpoint, I think it's been consolidating pretty nicely. And you've had a few areas over there, Ireland, Denmark, that have continued right through the mess, really without taking a step backwards.
Yeah, no, that's a good point. And it's interesting.
I think EWQ, now, of course, we're looking at this in dollar denominated. So I know like the CAC 40, and I guess they use euros now. CAC
out of
40,
France.
Yeah, out of France. So that's France's, for layman's terms, their S&P 500, their Dow Jones.
Ian, how is it possible with all those fiery protests going out there that we're almost at new all-time highs for the CAC 40? How is that possible?
Yeah, look at it. It's held up very well. If you look at the DAXs.
What's the DAX?
S&P for Germany.
Got it. So Germany, France.
Yeah. All these areas. I got to be honest, they've held up. If you want to look at European financials, not as good as Europe as a whole, which maybe that's, I don't know, maybe we're talking about this in 3 weeks. I don't think financials around the world have held up very well. I would say actually regional banks here haven't gotten a bounce whatsoever. We can get back to that later. But yeah, Europe, VGKs, they don't look horrible. What about you? You got anything internationally that you like?
Well, I think Argentina, surprisingly, it did have a little bit of shakeout here, but showed resilience into a base that goes back to 2018.
Yeah.
Talk about a 5-year base out of something Argentina. And, bring up the CAC 40 and the DAX is interesting because you're almost back to previous highs in those areas.
DAX looks good.
And meanwhile, and that shows that relative strength out
DAX
there.
on a monthly basis. Look at that candle. And how far are you away from all-time highs?
Right. And that's just it. You're not that far. Whereas S&P, you still have 16% to go to get back to all-time highs. So you are seeing strength internationally.
Got less 3.5.
And the way the trade-weighted dollar looks, I'm going to say something here because I do feel like there's a narrative going on with the dollar as well that in some ways is laughable to me. But the whole concept of the dollar losing its reserve status, we're going to let that play out for a few years if that's true. I don't want to make light of it, but it is interesting that it's happening in an environment where, yes, we are potentially have a false breakout on our hands, with the trade weighted dollar. And if we're below that 101.60 level on the trade weighted dollar, like the DXY, that would be a super tailwind for stocks.
I think so too.
And
yeah,
if we're,
dollar and dollars been below a 200-day, right?
and it's, below a 50-day, if we're back below a 101.40, 101.60, and we're heading down towards 90, that's typically an environment where you see stocks do well.
I think a dollar below 100, if we're using dollar index DXY, dollar below 100 confirms dollar weakness.
Yeah.
We're below 104, so we're halfway there. We're at midfield. I think punching it in the end zone is getting below 100. How we get there, I don't know. Are we pass heavy? Are we run heavy? I don't know. But
that kind of ties into, in a lot of different textbooks, they would say dollar lower, bonds lower, dollar higher, bonds higher. What are we seeing out of bonds and rates? I know one thing that's developed over the last 2 weeks is the start of the uninversion, right? That's a valid term to use, like the yield curve being inverted.
Uninverted. And that is, you're right, the macro people. I would say that's when your market troubles and economy troubles really start.
Yeah.
I can't disagree with that. I mean,
and at the same time, we've highlighted in here that same situation took place in the 80s. Stocks move higher. And that happened at a pivotal moment for the interest rate cycle overall. From that point forward, we saw higher bond prices, lower yields. Prior to that late 70s, early 80s period, it was lower bonds, higher yields. And so you could be heading into that environment as well. TBD.
Wouldn't that be a doozy?
Now, we've talked stocks, domestic and foreign, talked a little bit about bonds, some dollar. Do we want to talk anything crypto, commodities?
Crypto, I mean, holding up there. Bitcoin hasn't moved in really a couple weeks. So consolidating nicely. It's better than rolling over. And it continues to hold well above 25,000. So kind of stalled out here at 29, 30,000-ish, 28, 29.
And that's an area of polarity, right? I mean, that goes back
a ton.
Surprisingly, May of 2022.
How about that?
So May of 2022 has some important significance to it. And believe it or not, that's when some of the indictments were happening for individuals involved with illegal swaps. You go back to July of 21 and January of 21. Those are important lows in Bitcoin. And here we're back to that scene of the crime. So we're back to 4080 scene of the crime. We're back to the 29,000 Bitcoin scene of the crime. There's some things to prove here.
There are. And, Bitcoin on a daily, RSI looks a little divergy to me. We're going back to the big run up it had in January. So, and we can work that off. You can certainly work that off through time. Bitcoin's a pretty high beta asset. So
it is.
It can have a funky RSI and do whatever it wants. I will say Apple and Microsoft, say what you want about them. They continue to hold up very well.
And semiconductors. You could argue some of your home construction.
Agree.
And those are economically sensitive areas that have held up. When you look at like certain relationships, like staples versus discretionary, which can be skewed at times because of Amazon's involvement in discretionary, but you look at something like XLP versus XLY. So your staples, your cap weighted staples versus your cap weighted discretionary. We kind of, since the beginning of the year, rebounded, or I should say really since February, but could be rolling over in that relationship, which would be risk on. I know you brought up microcaps last week. Could we be seeing a false breakdown or in that particular product? That's to be determined. But if you've got something like IWC above 101, that thesis is alive. And now you would see small caps and microcaps stabilize, going back to that breath washout that now you have this support that's behind this market to be determined.
That's true. I think one thing that's got to be fixed too is this. Someone's got to fix biotech. I know that banks have got a lot of hate. Yes, they weigh on Russell 2000, but biotechs, from a relative perspective, also going to need them to get it together and at least start participating.
Yeah.
Because a lot of this small cap, when I go through charts, things that have held up well, I mean, they haven't rallied the best, but I put them they've had healthy consolidations and really didn't get hit that hard during the regional bank scare. I don't know if it's over, at least the initial regional bank scare. ARC, software companies, IPOs, solar.
There's an argument to be made for software basing out.
Yeah, internet. A lot of these, kind of your 2020 favorites, small cap growth type areas, held up pretty. Fangs
Yeah.
held up well.
When you say fangs, you don't mean the energy company, you mean the Facebook, Apple,
Yeah,
Microsoft,
FNGS.
yeah.
If you would like a ETF representation. ITB, I agree with you. ITB really hasn't flinched during any of this throughout March. Now it kind of it got hit in February with pretty much everything else, peaked in early February 1st or 2nd, but has held up well from a technical perspective.
And so
it hasn't held up well.
What?
The worst.
Pot stocks.
Pot stocks.
Yeah. Terrible. Like
Terrible.
No bounce anywhere.
Couldn't bounce a basketball.
No. Can't even dribble. I mean, so that's a great thing to highlight. So we keep talking about May of 2022 and YOLO down 57% since May of 2022. So lots of things flat, massive ranges, not easy. But what is easy was avoiding pot stocks.
Yeah, down 92% off the February 2021 all-time highs.
Doesn't even catch a bounce. And, it has caught a bid that hasn't been relevant and is an old name, Motorola. Going out at fresh highs, both on a daily and a weekly and a monthly. I don't know what Motorola has in store or what the narrative is.
Maybe they're not AI.
Yeah, who knows? I mean, and Pratty and I talked about this week that we're not going to be surprised by how many charlatans and snake oil salesmen and shenanigans comes out of AI, where people are just slapping AI on the back of everything.
Oh, they will.
Yep.
They do with everything.
Same with .com, right? When we came out of
humans will never miss a chance to grift off something in the stock market.
Yep. Just like, whether it was the metaverse or crypto, anything that was crypto, they threw their name on it. NFTs, they threw their name on it. They're going to do the same with AI.
They're monkey JPEGs.
Yeah. And so it's going to be the same story of human fear and greed. And I don't, the whole concept of this time is different. The thing that will never, ever, ever, ever change is the human condition after the fall of Adam and Eve, which is fear and greed. That will never change. And that belongs to AI. And it's fascinating, right? Watching some of these really big tech executives sign documents saying we need to pause AI. When are they just afraid that AI is going to be the next best thing? Because Ian, there was a time where there were headlines that were driven by railroad propaganda about how dangerous it was to drive a car.
Yeah.
That if you drove over 30 miles an hour, you were going to die.
Or
how dare
you were mid-90s.
That period where you don't know what a compact disc is, but there's
yes, I do, David. Oh my God, I'm not 9 years old.
So there was a period where we went from vinyl records to compact discs, and people freaked out that the vinyl record industry was going to go under, and how dare we?
Shame on that. Shame on innovation.
Right. Like,
you should just have a record player installed on your car dashboard.
Yeah, exactly. Or on my hip while I'm running, I'm going to have a vinyl record.
Yeah.
And now we're sitting here with digital, I don't even know if they're MP3s anymore, to be honest, but
I think it's just all streaming.
Right. And So here we sit and we're on the doorstep of AI and we've got people saying we shouldn't do it. It's the same story over and over. We shouldn't have trains. We shouldn't have cars. We shouldn't have CDs. We shouldn't have MP3s. We shouldn't have AI. It's the same story because humans, we just do the same thing over and over again, but we refuse to believe that it could possibly happen in our time frame.
It wouldn't.
Yeah, no way. So
no, I know it wouldn't.
So awesome.
This time is different, Dave.
Yeah, it is. The famous last words. So we're bumping up against the end of our time. I'm losing my voice a little bit, and I apologize for that. Anything else you want to cover before we roll out of here?
No.
All right. With that, we appreciate, again, everybody that listens, gives us 5 stars, high rankings, shares it with their friends. It's a way that you can pay us back. We really appreciate it. Thank you.
Have a great weekend, everyone.
Hey.